Good afternoon, everyone. We're going to get started. I'm Peter Orszag, CEO of Lazard, also a board member here at the Peterson Institute, and I want to welcome you to today's webinar at the Peterson Institute for International Economics, entitled The U.S. Vision for Global Debt and Development Finance, a conversation with Jay Shambaugh, U.S. Treasury Under Secretary for International Affairs. In its latest World Economic Outlook, the IMF reported that a rising share of countries, something like 56% of low-income countries and 25% of emerging markets, are in or at high levels of debt distress. And what Jay will lay out is this is not in general because debt to GDP ratios are off the charts or at exceptionally high levels, but instead it's a result of more burdensome debt servicing conditions and the nature of debt flows over the past several years. So some combination of the end of low interest rates and changes in the patterns of financing flows, which we'll get into after Jay's speech. It's also, this speech is occurring at a moment where there are at least two big underlying tectonic plate shifts in the global debt dynamic. One that's been happening for a while is really the erosion of the two main pillars of that system 20 or 30 years ago, the Paris Club and the London Club. So if you think back 3 decades, 4 decades, this topic, especially once you got into restructuring of debt, but even the issuance of debt, was complicated but organized because the Paris Club basically dominated official flows, and the London Club of Banks dominated private flows. And today, along both domains, the world is much more complicated. The entry of China in particular as an official creditor has changed the dynamic in that part of the debt world. And then the proliferation of private creditors across a whole series of new entities that are lending to sovereigns relative to 30 or 40 years ago means that you've got a much more dispersed creditor base in the private sector. The second underlying tectonic plate shift is the energy transition, and the Undersecretary will discuss this a bit, but clearly there is an interaction between climate change and the energy transition and the debt dynamic in many countries that are struggling with debt servicing and with financing flows at exactly the same moment that the world needs to accelerate the energy transition and also lead to mitigation and other measures in those very same countries. So we are delighted and honored to hear today from Jay about the Treasury Department's vision for how the international financial system can address these challenges, particularly at a time when sustainable development and climate change is of critical importance. I won't belabor Jay's bio. You have it in background. I will just note that among the other highlights of his career, he is one of the few directors of the Hamilton Project, which is obviously near and dear to my heart. So with no further ado, Jay.
Thanks very much, Peter, for that very kind introduction and for really setting the stage for what I want to talk about today. And for noting the importance of the Hamilton Project on my CV. And I also want to thank Adam Posen and the Peterson Institute for hosting me here today. So in September of last year, I laid out what I think of as kind of the U.S. Treasury Department's view of how the IMF could meet challenges facing low and middle income countries. And what we want to do today is kind of widen the aperture a bit and think about how the overall international financial system can help low and middle income countries face the challenges they're seeing, especially at this particularly high stakes moment in sustainable development, as Peter noted. So I want to start in a sense with how the system could or should work. Low and middle income countries committed to ambitious development and sustainability goals and pursuing sound macroeconomic and sectoral policies should be able to access financing for productive investments without facing debt distress. So we want such countries to, over time, develop kind of domestic resources and capital markets, but meanwhile, they should be able to invest in their sustainable development needs at a pace that is faster than their current domestic resources allow. And they should do that by drawing in net financing flows from the rest of the world. So naturally, their low levels of capital relative to the rest of the world and potential for faster growth make them kind of a natural place for global capital to flow. This is especially critical given the scale of investments needed to address cross-border challenges like climate change, pandemics and global health, and fragility and conflict that can undermine and reverse hard-fought development gains even in the best managed economies. But too often, we're seeing financial flows on net flow out of low and middle income countries, with the burden of debt repayments actually exceeding new financing. And such net outflows from low and middle income countries, particularly to official bilateral and private sources, are at multi-decade highs right now. So per the World Bank, over 50 low and middle income countries experienced net outflows of public debt to official bilateral lenders over 2021 and 2022, the largest such group in nearly 20 years. These outflows are to emerging official lenders, even while the Paris Club that Peter was referring to, the financing from the Paris Club roughly held steady in aggregate. Adding to this, nearly 70 low and middle income countries experienced debt outflows from private creditors in 2022, the largest ever group recorded in data. So, though IFI financing has surged to fill in the gaps, the net result is that almost 40 countries experienced external public debt outflows in 2022, including 14 in Africa. These flows likely worsened in 2023, with, for example, no bond market access at all for sub-Saharan Africa in 2023. They could also continue to deteriorate over the next 2 to 3 years, particularly given that scheduled principal repayments to all creditors as a share of GDP are more than doubling in 2024 and 2025 relative to the average level from 2010 to 2019, based on IMF data. So it's not just that the net flows are negative for some subset of countries. Overall flows to the aggregate group of low and middle income countries have declined. And that's something that's really incongruous with the massive needs we're seeing for development and climate financing to these countries. So over the last 2 years, net debt flows to developing countries fell by over 50% to their lowest level in over a decade. For the poorest countries that rely on official development assistance, net debt inflows in 2022 were almost 80% lower than their 2014 peak, close to their lowest recorded level. And so this is not simply a matter of less money flowing in. More money is also flowing out of these countries. As a share of both exports and revenue, external debt service has risen to levels not seen in nearly 2 decades. This is despite current levels of outstanding sovereign debt stock being well below prior peak levels. Public external debt service as a share of revenue is now 14% for the median low-income country, over 2.5 times higher than it was a decade ago, and it is now typically exceeding the spending on health, education, or social programs in these countries. This fiscal pressure is especially daunting against, again, the backdrop of hundreds of billions of dollars of public investment needs in these countries to meet their sustainable development goals over the coming years. Now, this is not to say that all low and middle income countries face this exact fact pattern. Some countries have emerged from COVID without a rise in debt distress and continue to enjoy robust financing from both external and domestic sources. And others lack the governance or reform commitments or sustainable development goals to really warrant a large amount of financing coming in. Nevertheless, many countries operating in good faith are caught in these conditions with significant official bilateral and market debt and facing realistically alarming trade-offs due to falling flows and rising debt service. So this sobering and disturbing reality for developing countries from our perspective is a generational challenge. And like prior generational challenges in debt and development, it calls for the international community to step up and take decisive, coordinated actions. We have the tools to meet the moment, but we must strengthen and use them much more effectively. In response to that imperative, I'd like to lay out today a vision for international finance where all stakeholders are incentivized to sustain net positive flows to IMF and MDB-supported program countries who are doing the right things, pursuing responsible macro policies, and prioritizing sustainable development goals. And so this vision has three facets. First, we need a pledge from bilateral creditors, official bilateral creditors, to act in coordination to sustain high-quality net positive flows to such countries. When the IMF and MDB support countries' reform and investment plans, fund shareholders should not be withdrawing their own financing. This does not necessitate haircuts necessarily for solvent countries, but rather a basic expectation of refinancing or reprofiling absent new liquid financing, increased grant flows, or haircuts being applied. We should be enforcing and incentivizing these norms, including through changes in IMF policy around lending into official arrears and financing assurances, as I'll discuss further. Second, we need a way to help developing countries with significant external market debt sustain private flows at affordable terms over longer time horizons. Private outflows should not be netting out against IFI inflows. It's time to implement market incentives and mechanisms at scale to mobilize lower cost, longer term, and shock-resistant private flows to low and middle income sovereign borrowers with sound policy frameworks. We need this both for traditional projects, but also for investments based on budgets. Third, we need coordinated packages of support for countries that use newly expanded IFI resources to sustain cross-IFI flows for debt sustainability and sustainable development in smarter, integrated, and additive ways. This should be IFI-led and country-owned and use new resources from facilities at the IMF, from balance sheet optimization at the MDBs, and from better use of existing pools of concessional finance and new development finance institution tools, and even philanthropic pools. It's important to pair flows with scaled-up technical assistance in priorities like domestic resource mobilization and strengthening investment climates. So I'll discuss each of these in detail: official bilateral sources, private sources, and IFI financing. Before that, though, I do want to mention up front that realizing this vision does depend on an IMF that is seen as a credible steward of country programs and of well-functioning restructurings for borrowers that need it. Fund resources and policy must incentivize strong macro and sectoral reforms that put countries on a viable path and unleash private flows. Such as in, you could take the recent case of Egypt as a case where the fund took a very strong stance and money flowed in from outside of fund resources as well. If programs are not rigorous and credible, countries can find themselves worse off despite the IFI flows, and programs will not draw in private finance in those cases. By the same token, while my focus today is on helping countries who are in a solvent situation before restructurings are needed, we must also acknowledge that the sovereign debt architecture needs to be delivering deeper and more timely restructuring and doing so more consistently than it has been doing for many countries. We've seen progress in some country cases, and that is important, but we must improve the common framework so we can more expeditiously deliver debt treatment to countries in crisis. So, if we look at official bilateral financing, we think it should reflect the norm that creditors coordinate multilaterally to sustain financial flows to borrower countries that are steadfastly pursuing IMF and MDB-supported reforms and investments. And historically, creditors followed this norm. And yet, we are seeing some emerging creditors that do not follow this norm, with consequences for global debt distress and sustainable development. Lately, you could say for over 40 low and middle income countries, cumulative net debt flows from Chinese creditors since 2019 has actually been negative, and almost all of these have had recent IMF programs. So all official bilateral creditors, particularly major IMF and World Bank shareholder creditor countries, should pledge to act responsibly, providing durable financing that further incentivizes and is commensurate with reform efforts by borrowers. No individual creditors should be free riding by pulling funds out of a country while it is implementing IMF and MDB supported reforms, and other bilateral and multilateral creditors are at the same time refinancing or rolling over funds or injecting new resources. So to be clear, reverting to low quality official flows of recent years from some emerging creditors is not the answer. Financing from official creditors, including that which IMF brings in to fill program financing gaps, must be credible and transparent and aligned with program goals. Ultimately, countries need strong macroeconomic fundamentals, hospitable business environments, and sound practices in transparency and governance to unlock stable and affordable flows of financing, including private capital and domestic resources. And all official financing needs need to be aligned with that direction. And so this includes bilateral project finance, which should be transparent, the opaque extractive project finance and trade credits that help lenders promote their own exports are not credible program support. In the same vein, for many lower income countries needing support, official bilateral flows should more often entail direct budget support, new grants, and concessional financing rather than non-concessional loans in order to protect the debt sustainability and free up public balance sheets. And so for this reason, the United States, along with many other creditors, significantly reduced loan exposure to developing countries following a wave of debt treatments in the 1980s and 1990s, and has since transitioned to being a leading provider of grants to these borrower countries. It would help if more emerging creditors made this shift as well. So for example, the United States has dispersed over nearly $70 billion in aid to sub-Saharan Africa in the last 5 years. Nearly 7 times the net debt inflows from Chinese creditors, and more than half of the $130 billion in total net debt flows to sovereigns in the region during that time period. If the United States had instead been providing debt instead of grants over that time, the United States would be far and away the largest creditor to these countries and also be leaving them in a much worse debt position than they're in now. The international community should be prepared to enforce and incentivize norms around official debt flows, including through IMF policy and comparability of treatment restructurings. And so in this spirit, I do want to highlight the IMF board approval of the fund's proposed policy adjustments to its lending into official arrears policy and to its financing assurances review. These changes will not only allow the IMF to move faster with program financing to debt-distressed countries, they are also a step towards aligning incentives for all official bilateral creditors to participate responsibly with restructurings, reschedulings, or new liquid finance to borrowing countries. Multilateral guidelines should likewise codify norms around transparent, high-quality official flows that are aligned with overall debt sustainability objectives, such as the OECD's sustainable lending practices and officially supported export credits guidelines, which the United States, including EXIM, is an adherent, but not all G20 countries are. Second, we can talk about private capital. For developing countries with strong macro frameworks and development policy ambition, specifically those with significant market debt, external private funds should not be flowing out as IFI money is flowing in. Spikes in debt service costs can also draw public resources away from immediate development needs. MDBs and bilateral institutions have for many years facilitated market financing for developing countries with long tenors and stable outlook needed for successful project finance. It's time we do so at greater scale and also for publicly budgeted sustainable development investments. And this means incentivizing external private funds to stay in at attractive terms and provide immediate relief for sovereign borrowers facing debt distress from sharp adjustments in external financing costs and availability. The view is that we can help preserve market access with 2 underutilized features of sovereign debt and development finance: credit enhancements and borrower protections. And these features are complementary to one another. And they are likewise complemented by ongoing private capital mobilization initiatives for project finance, such as securitization and originate-to-share approaches that free up MDB balance sheets. So first, well-structured credit enhancements from MDBs or DFIs, such as loan guarantees, can help flatten out the spikes in public debt service costs that we've seen over the past 2 years. They can also help procure longer tenor financing and shift creditor composition to more stable sources for long-term development, both for public project finance and budgeted investments. While they must be applied judiciously, given resource constraints and other considerations, we can scale these in a targeted way for borrowers around debt amortization walls without curtailing traditional concessional finance. So MIGA is already active in this space with its non-honoring sovereign financial guarantee product. It has the balance sheet space, though, to do more, including by using more inclusive credit rating thresholds for developing countries aligned with an IMF program and by increasing guarantee limits. The IDB has been an innovator in this space by piloting a top-up of its volume of financial support for sovereigns that pursue guarantees rather than loans. But more needs to be done, including instilling the right incentives around opportunity cost accounting for staff to prioritize deployment in their country engagement. All of this actually builds around momentum for scaled-up guarantees for project finance from the launch of the World Bank Group Guarantee Platform this summer. Bilateral guarantees should also be aligned with and amplify these efforts for sovereign borrowing around sustainable objectives, both for general public borrowing and publicly guaranteed project finance. When used in the right context and where funding is available, bilateral guarantees can fill in gaps left by exposure limits at the MDBs, free up lending for global challenges, and be deployed flexibly. For instance, bilaterally guaranteeing risk held by the MDB balance sheet, such as through sectoral initiatives at the ADB or IBRD around energy transition lending, can in turn achieve outsized leverage via MDB headroom. The United States is actively exploring these tools right now, as well as others from the DFC, and we encourage others to do so. I want to highlight ongoing work by the US DFC and MCC to improve and scale up the use of credit enhancements to support issuance of debt for nature swaps and sustainably linked bonds in the technical task force established after COP28 and other forums. Second, we should create safe harbors for countries seeking proactive relief from private debt distress on a voluntary, market-aligned basis. Borrower countries should be able to proactively sustain private flows through consensual, largely net present value neutral debt treatments, including standstills, buybacks, and exchanges where appropriate, without suffering from ratings downgrades and losing market access. And to that end, the IMF, much like it did with collective action clauses, has an important role to play here, promulgating contractual mechanisms like state contingent standstill clauses to shield sovereign borrowers collectively without stigmatizing any given individual borrower from global or regional changes in external private finance. Efforts underway at the World Bank, at the AFDB, the EBRD, the EIB, the IDB to incorporate climate resilient debt clauses into loan agreements are a starting point and really should be paralleled in the private loan market where possible, as well as in bilateral development finance and export credit. IMF research indicates that collective action clauses have benign effects on sovereign yields, and the same could ultimately hold for well-structured state contingent clauses. For buybacks and exchanges, I likewise urge the IMF's and World Bank's Global Sovereign Debt Roundtable to further engage credit rating agencies to address borrowers' concerns around adverse impacts that disincentivize these transactions. So you could think of kind of debt for something type of swaps or similar transactions. They can't substitute for comprehensive debt restructurings or other forms of relief, but they can provide material private flows where conditions align, and the international community should incentivize these types of transactions. In addition, key financial jurisdictions for sovereign debt narrow, targeted updates that avoid market disruption, such as indexing prejudgment interest rates to prevailing market rates, could help further align incentives for net private flows. So finally, I want to talk about the IFIs. So IFI, we have seen significantly expanded and really still expanding IFI resources, and we need to use these to sustain IFI flows in ways that advance countries' ambition for development and sustainability. Today's financing challenges would have been much, much worse without the extraordinary financing support from the IFIs during the pandemic. From 2020 to 2022, this collective support accounted for nearly 60% of the total net debt inflows into developing countries. With hundreds of billions in new IFI capacity we've achieved through recent efforts from MDB Evolution and the implementation of the Capital Adequacy Framework Report, we must now work to have these resources come together strategically and maximize impact. It's difficult to overstate the scale of the opportunity with these additional IFI resources. You could take the IMF. The United States was a strong supporter of the 50% expansion in quota resources that the IMF approved last year. And the Biden administration is also very pleased that Congress authorized the United States to lend $21 billion to support low-income countries through concessional financing from the Poverty Reduction and Growth Trust, or PRGT. Building on that momentum, I would echo the call that I made last fall for IMF members to further support the PRGT by using future lending income to meet the subsidy needs. In addition, the IMF's new RSF has now up to $40 billion of new lending firepower, which is focused on long-term financing and sustainability. The IMF Executive Board has approved commitments so far of $8 billion to 18 countries, the majority of which is on track to be dispersed by the end of the year. And if we were able to formalize the IMF's collaboration with the World Bank and the WHO so that the RSF could tackle risks associated with pandemics, that could deepen its impact. The MDBs are likewise seeing historic expansions in financing resources as a result of MDB evolution. We have made great progress on this front, particularly through implementation of the G20 MDB Capital Adequacy Framework Review recommendations that are enabling $200 billion in additional financing capacity over the next 10 years. There's space to go even further, particularly around boosting concessional finance, and we're seeing countries take action to this end. President Biden's FY25 budget request includes funds for a U.S. guarantee that would enable an additional $36 billion in World Bank lending for addressing global challenges and a large U.S. contribution to trust funds and financial intermediary funds. More broadly, the MDB Evolution Initiative seeks to not only expand the ability to lend by these institutions, but to make that lending more agile, more effective, and better channeled to solving cross-border challenges like climate, pandemics and global health, and fragility and conflict. Reform around incentive structures and operational approaches will make the enhanced lending capability even more impactful. The United States has also been supportive of capital increases where capital is the binding constraint on lending, for example, at the EBRD and IDB Invest. MDB boards should periodically evaluate the need for such investments by shareholders. This is the moment to integrate these expanded IFI balance sheets with technical assistance and cross-stakeholder leadership to make progress on debt sustainability and sustainable development. This includes by unlocking new and high-demand concessional funding pools in the climate finance architecture. And so one opportunity there will be in the recommendations from the forthcoming G20 Finance Architecture Independent Review. Other important sources include the Pandemic Fund and the Global Concessional Financing Facility. Another important opportunity to update the system is the ongoing joint IMF and World Bank comprehensive review of low-income countries' debt sustainability framework, which should incorporate borrowers' sustainable finance considerations, including risk adaptation and mitigation costs. This would build on enhancements that have already been made for the IMF's framework for market access countries. But updating these tools is only impactful if they're actually then used effectively. Consistent with my earlier call for credible IMF programs and restructurings, I'm calling on the fund to ensure that debt relief envelopes and program financing are commensurate with what countries need to pursue ambitious development and sustainability goals. Ultimately, IFI flows should be aligned with country priorities, strategies, and plans to help cultivate domestic resources and capital markets. The most durable flows for sustainable development. Too often, countries borrow externally and take on financing risks to cover fiscal deficits that wouldn't exist if they were able to collect domestic financial resources at the same rate as developed countries. Domestic resource mobilization reforms can also bring in much needed foreign currency, relieving the balance of payments pressures with hard currency borrowing. The United States Treasury, through our Office of Technical Assistance, dispatches public financial management experts to help governments around the world strengthen their ability to better raise and manage domestic resources through improved revenue, budget, and debt management. One such project in Angola generated fiscal flows of $125 million each year by successfully helping to lower costs, reduce risk, and more efficiently manage sovereign debt. In the same spirit, last year, the World Bank dramatically expanded its support for domestic resource mobilization reforms that will create fiscal space through both revenue policy and administration measures. and addressing spending inefficiencies and harmful subsidies. We'd like to see other MDBs in coordination with the World Bank move in a similar direction. So, the international community has made significant progress in recent years with strengthening tools across the IMF, the MDBs, multilateral trust funds, and DFIs to help prevent debt distress from impeding developing countries investing ambitiously and productively in sustainable development. If we use these tools in coordination across stakeholders and think expansively about their application, they can add up to something much greater than the sum of their individual parts. And so with such a process, a country committed to sound macro policy and sectoral ambition for sustainable development would have the ability to responsibly invest in its needs. The IMF and the World Bank could reestablish a credible policy anchor and development path. Official creditors would pledge grants and concessional financing over the path alongside funds from other MDBs, maximizing the impact of these IFI flows. Private funds would likewise stay in some cases due to MDB and other credit enhancements, so that IFI funds would not merely refinance private debts. High-quality project finance from MDBs, DFIs, and trust funds and export credit agencies would complement general budget flows by funding public and private balance sheets. And financing conditionality would be tied to technical assistance to drive reforms and mobilize domestic resources. The goal would be to maximize external and domestic resources to help countries making productive, ambitious investments. There are a number of countries who are doing the right things with their macro and sectoral policies, including doing their part to address in ambitious ways the climate, pandemic, and global health and conflict and challenges that we've already talked about. But they're still facing significant debt amortization in the next 24 months. The international community must make sure that the international financial system is there for these countries. All stakeholders will find the United States an enthusiastic partner and leader in realizing this vision. Thanks.
All right, thank you, Jay. So why don't we start just with, I think that was compelling, but let's start with some facts.
Sure.
So the debt statistics from the World Bank suggest that at least for 2023, the vast majority, 80, 90% of the decline in flows that you were highlighting was from a reduction in private creditors. Mm-hmm. And then there's a residual category that is exclusively China in particular. Is that your sense of the current reality?
Yeah, it's private and emerging bilateral, primarily China, more private than emerging bilateral.
Okay, so now let's get to the second part, which is on the emerging markets in particular.
Yeah.
Because I think it's easy to use, you were very careful, I think you said emerging markets many times, and you said China a couple times.
Yeah.
But isn't it China?
It's primarily China. They're not the only emerging creditor. There are other kind of non-Paris Club creditors out there who are participating in these official creditor committees for the countries that have run into trouble. China's the biggest source of financing over the last decade that then is hitting walls now where they're kind of pulling money back.
Right. So let's start there, and then we'll turn to private creditors and to the IFIs in a second. But so on China, effectively what you're saying is that the Chinese, I mean, yes, there are other emerging markets, but let's cut to the heart of it. The Chinese should not be pulling back on financing flows for countries that are in IMF programs or sort of behaving well.
Yeah.
Okay. So can you just walk through a little bit the philosophy or the principles behind, so country X, in this case China, extends a 3, 5, 7 year, whatever the maturity debt is, and it's got an end date on it. Mm-hmm. And what we're now saying is because most of this is the ability to roll over that debt. Okay. So in a sense, what you're saying is there should be an expectation that you'll roll over that debt, which means the initial loan was not really a 3, 5, 7, whatever. It's something much longer, and obviously the interest rate that's attached to that might be different. Do we really want to go so far as to say it should be I mean, you did, so apparently we do, but I just want to press a little bit on the philosophy behind that almost moral expectation that once countries have extended some debt, they should be almost perpetually rolling it over as long as the country's in the good graces of the IFIs?
So the place I would have a slight amendment there is perpetual. So the idea here is, I mean, there are plenty of countries that are in the good graces of the IFIs that are not kind of at a moment of crisis where they're going to the IMF and getting a new program and trying to sort things out, right? So there are plenty of countries where you would just expect the money to be flowing back to any creditors if they don't see any reason to put new money in. And that's just normal business. You're switching creditors, or maybe you're borrowing less and paying back on that. Fine. The point is, when you have a country that hits a crisis of some sort, it could be an exogenous shock, it could be some prior government made some bad choices around debt management and they've got a huge wall coming due and they're just unclear how to get through it, and so they're getting some support from the fund. But if they're showing up to the fund and they are doing the right things themselves, restructuring their budget, putting in sound macro policies, they've got an ambitious development agenda there. What we don't want is the resources that collectively all shareholders put into the fund to be going to that country and then just turning around and going right back out to another big IMF shareholder, right? So I think, and when you say it feels
which
like
shall remain unknown,
which shall remain unnamed, could be any shareholder.
Right.
But when you say it's kind of a moral thing, I think what we're saying is this was a historical norm. You referred to the Paris Club, like that's what the Paris Club did. The Paris Club would never take money out of a country in year one of an IMF program. They dealt with the financing assurances so that on net, the financing assurances are there and things will work out. It's not like it was charity. They did things in an NPV neutral way. They made sure that they were getting paid back later for a country that was solvent. Obviously, it's a different question if you've got a country that's run into debt distress and is unable to pay. And so that's what we're saying, is we need to reestablish that norm, because otherwise the IFIs, the surge in work we're doing to get the IFIs to put money into countries is just going to go back out. And that's
so let's talk about how to get there then.
Yeah.
Because look, I mean, the Paris Club historically was a relatively homogenous group of leading countries that were the official creditors. China's entry into the official creditor game obviously changes that dynamic. So how do you go about creating that sense of unity or common purpose in a more disparate group of official creditors? Question one. And question two, I would have hoped that this would have come up on your recent trip with the Secretary to China.
Yeah.
So any updates that you can provide?
I'll do the second one first. I mean, what I can say to that is, I don't think there's been a single engagement with the Chinese at her level or my level in the last 2 years where sovereign debt distress didn't come up. It's a big topic. It's one we raise. We think it's important. They think it's important. One thing I think that has been crucial is we and they have insisted this is not a bilateral stress between us. This is not a bilateral issue. This is when we talk about how, as the two biggest economies in the world, we need to be able to work together on global challenges. Sovereign debt distress in low-income countries is a global challenge. We need to be able to work together on it. And so we do talk with our Chinese counterparts all the time.
And what kind of reaction do you get?
It depends. I mean, sometimes when we're talking about an individual country case of, we're trying to figure out what's taking so long, what needs to happen, and trying to work through what their concerns are, whether it's something about the comparability of treatment. As I know, often these things are highly technical, and sometimes there really is, like, they disagree with something in the comparability of treatment relative to some other creditor, and you need to work through that and talk through that. They have questions about the debt sustainability analysis. It could be any number of things.
I'm going to come back to that.
Yeah. And so what we try to do is what we have been trying to do as a creditor who's been around longer and has been through more of these, is to try to make sure we can talk to the Chinese about how their system can get to yes faster, but also how we can make sure the global system is working in a way that works better for their system, and so that everybody understands each other. To your first question about, is it harder with a less homogenous group? I mean, I think the short answer is sure. The more homogenous group, though, has had a lot more practice at it. And so part of this is things like, frankly, the Global Sovereign Debt Roundtable has been really helpful to get a lot of big creditors around the table, but also a bunch of borrower countries, where the borrowing countries can sit there and say, this is why this is really bad for me. And taking an extra 6 months is not costless. People are starving in my country until we can resolve this. Like, that's helpful. That's impactful. Having the private creditors at the table at the same time is really meaningful. And so I think there are things we are doing to try to make progress. Those are the debt distress cases. On the non-distress cases, I think the argument, when you say, how do you get the Chinese to do this? So one answer is you say, it is in your interest, as well as all of our interests, that these cases that you might think of as a liquidity issue, right, where it's really a debt service cost spiking or something, that not turn into a solvency issue, because then we're dealing with restructurings. And it is in your interest, just like everybody else's, to collectively make sure the financing assurances are there. We can get things moving quickly. We don't have a 6-month delay that leads to the fund program falling apart because chaos erupts in the country. And so it's in their interest as a creditor, is what you're trying to convey. That's part one. Part two, I mentioned the lending into official arrears. And so part of it is saying we need to align the incentives for the creditors to say, if there are problems that result, we don't let one hold-up creditor have the whole thing fall apart, and we have tools that we can use if we have to in the cases where we're able.
So let's turn to the IFIs. A couple of questions on that. I mean, at the heart of many of your proposals is the credibility of the IMF in particular.
Yep.
The programs, the DSA, the debt sustainability analysis. And I would say there have been more prominent critiques and questions, not just about the traditional Washington orthodoxy, which they've moved slightly off of, but also even from a technical perspective. Most private creditors now have their own in-shop debt sustainability analysis folks who can go toe-to-toe with. So how do you reestablish the credibility of the IMF that I think is under both a kind of macro level attack, but then also even at a technical level in a lot of these negotiations or discussions? It's not just the IMF says X and therefore everyone bows and says, okay. It's now, well, no, I think, cell 47 is off.
Yeah, I think there are two aspects of that. So the first one, when I'm talking about the credibility of fund programs, is saying we need to make sure people, when they see the IMF reach a staff level agreement with a country, that the program goes through the board and the program starts, that private creditors and others say, oh, okay, this country's going to be okay. Like, that I really believe that the problem will be fixed, that it's not something that's just going to keep getting rolled over at the IMF. We want countries to be able to go into a fund program and exit kind of doing okay on their own.
And how would you judge the IMF on that question right now in terms of success and credibility?
I think there's some programs that have not worked out as well as the IMF would have wanted. I think there are some cases where we've seen the IMF kind of hold firm on what they thought a country needed to do. And I think when they take that path, it's far more effective, because then I think you do see either bilateral or private money start to flow in. And so I think that's the view. It's never easy to be the one saying no, but I think it is the case that the IMF is in a truly unique position in the international financial architecture as a source of both funding and macroeconomic policy rigor. And so they are really the only one who can play that role, and that's why it's so important they do.
All right, so another quick question. I have two more quick ones, and then we'll open up to the audience. So staying on the IFIs for a second, but also the Paris Club. So coming back to the Chinese in particular, it would not be unreasonable for China to look at both what you've said and the overarching arc of many of these interactions and say, you're asking us to do a bunch of things here. We don't really have sufficient voice in these organizations and in these institutions. These are your institutions that you're now asking us to kind of backstop or support. And at the same time, there's this de-risking debate, discussion, and there's a clear pulling away. So what is the answer to that? And is giving them more voice at many of these organizations on the table or not?
So what I would say on the giving them more voice, I think the United States has been clear. I think I've said it. I think the Secretary said it, that we think there needs to be a new formula for IMF quota that would be based more on country size, and that would be a helpful way to proceed going forward. And so I don't think China would have much argument with us on that front. I also don't think it's quite fair to say these are your organizations, right? In the sense that China
I was trying to be provocative, yeah.
China is still one of the major shareholders at the IMF, typically fills one of the deputy managing director slots. Like, they are a major voice and leader at the fund and at the bank. So I take your point that they weren't as large a voice when these institutions started, but they're a very large voice now. And I think that's part of the point here, is saying that major fund shareholders have to think about, what do we need to do to make the fund successful?
All right, let's turn to private creditors for a second.
Yeah.
So can you elaborate a little bit more on the tools that you see to induce or incentivize creditors to increase their exposure, especially the climate-related debt instruments, when they would have provisions that trigger off during a climate emergency, or that have other aspects to them? Just talk a little bit more about how you're going to induce demand among the creditors for that.
Yeah, so I think we see it as kind of two pieces. There, kind of the creditor enhancement side, where you can use guarantees. You can't use them for everything. The financial flows are larger than the balance sheets of these organizations could support. But in cases where you have a country that kind of is doing the right things and needs this support, and has maybe a bunch of private money that is about to roll over, or needs to roll over, that you could go in with some credit enhancements, some sort of loan guarantees in some cases, to try to get them, to try to keep the private sector in some sense. Or from day one, have some of those things to try to get longer tenors, lower rates, more attractive, sustainable financing. So part of it is trying to use them on that side. And then the other side of it, though, is trying to make sure that the money that's being lent is being lent in a way that, if there is some sort of exogenous shock, the country doesn't wind up in crisis. Now, in theory, that the creditors shouldn't mind that either, right? They don't want to see the country go into debt distress, because then they're stuck in a multi-year debt restructuring, which is no fun for anybody, or anybody's balance sheet. So I think the goal there is to say that it may be the case that, much like with collective action clauses, which were in some sense the same thing, how do we make sure when there's a problem, it's resolved in a better way? That people wondered, are private creditors all going to balk at that? And as it's turned out, the answer is they don't seem to. Possibly because they look and say, I'd rather actually be in a debt restructuring where there are collective action clauses than not, because I don't want to get caught in a holdup problem. And so the idea is, you could have, especially when it's clear that you can link this state contingency to something that's truly exogenous to the country's policies, so there's no kind of moral hazard issue. Climate resilient debt clauses are the ones that we're starting to see at a lot of the multilateral development banks, to just put them in as a matter of course and say, something happens, we're not going to hold you responsible. And our point is, some of these, if they're well designed, state contingent contracts might be a useful thing that the private sector might say, oh, actually, this does help us from problems of our own creation.
All right, I'm going to sneak in one really quick question, but then please, we're going to open it to the audience. So anyone who has a question, please ask a question. Really quickly, we mentioned interest rates as being one of the factors. Interest rates are affected by the course of inflation. We've had 3 now inflation prints in the US that suggests maybe a pause in the disinflationary process. What is your conviction level at the Treasury Department about ongoing disinflation in the US? Was this a one-off seasonal thing, or is there a problem?
So first, when connecting inflation to interest rates, I'm going to start off by saying the Federal Reserve is an independent institution, and we at the Treasury Department have no opinion on what they should do with monetary policy. They set monetary policy and are in charge of managing inflation.
That was not the question, but okay.
Nope, but I like to get that disclaimer out there. But if we're looking at inflation from the Treasury's view, I think we see the trends are towards disinflation. We think the things that we've seen, both the labor markets having supply and demand a bit more back into balance. You've seen kind of vacancies to unemployment ratios come way down, not quite to where they were pre-pandemic, but actually getting closer. And so we know there's some technical factors. We know there's some factors around around the timing of when housing inflation will start to show it coming down. And we also know that, look, the economy is doing well. It's doing better than people expected, and so I think the inflation has not come down quite as fast as some had expected, but part of that is just the economy is doing a lot better than people had expected.
Okay, questions? Oh, we'll go there.
Hi, Russell Green at the IMF. Jay, thank you. It's a great talk, a great set of proposals to think about. One of the things that you mentioned is that the bilateral existing debt stock, a lot of that represents non-transparent debt that was for project finance or trade credit. And one of the things that you proposed was shifting that to more transparent, I forget the word you used, something like more credible debt. So the question is, within an existing sovereign, that may mean big shifts in who's actually doing the lending inside that country. And so I wonder if you could talk about what that would look like in practice.
So, I mean, I think you're right. So I think you could imagine in some cases if a country is, showing up at the fund and the fund program needs some financing assurances from the major creditors. On the one hand, you could have just the existing creditor within the country agree to roll over in some way, restructure the flows. But alternatively, you could imagine a different source within that country making new loans that are transparent and straight to budget, not limited to projects, not limited to export credit where the money's coming back to that country. That would be another route to shift the country to a much more transparent thing. So that's going to depend on the country, how they would structure it, and if they're able to structure it in that way, or whether it is easier to roll it within the existing creditor.
Could I just say, if you have any thoughts on how China might do that specifically?
So, sure, obviously you've got different lenders within the structure, and it's more complicated, I think, for China because the line between public creditor and commercial creditor is a lot more blurry, and in some cases, in different cases, it seems different creditors may think they're on one side of the line or the other. But you could certainly imagine whether it's direct bilateral loan or from PBOC, if something is done in a very transparent way, that might be one way to get around some of the problems we've seen where there's so little transparency on the debt, it actually makes the debt restructuring really hard or makes figuring out the financing assurances really hard because it's a little unclear what's owed and when and against what collateral.
Sorry, we'll go there and then and that may take us to then. That might be the three questions.
So thank you so much. Good to see you. Can you tell a little bit about some of the engagements you've had with your counterparts in China on their takeaways from the Common Framework experience? Because there were a lot of lessons learned. Zambia was actually, unfortunately, it took 3 years, and I think we want to avoid that in the future, as you pointed out. But particularly with the point of transparency, do you think that was understood from both the official and quasi-official lenders in China that you've engaged with? And are there any other constructive lessons you think they may have learned in the process? Thank you.
Yeah, thanks. It's a great question. I would say, based on both bilateral interactions, but also interactions through the Global Sovereign Debt Roundtable, I think, transparently, I think everyone has learned a little bit about where everyone else is coming from in a helpful way. I think, one example might be a few years back, you would often see the Chinese say publicly that they thought MDBs should be taking large haircuts in these situations. And I think over time, recognizing that actually MDB flows are just different, that they're coming in pre-crisis at highly concessional levels already. And actually, in most of these cases, once they're in this situation, they're just distributing grants at that point. And so they already are, by their normal rules, highly participatory. And therefore, you don't need to ask them to change the rules. And I think that was helpful, kind of working through the math with them of how this looks. So I think that's something that you've seen, frankly, them move away from. I think a lot has been, though, them also trying to explain their system and the timing of how and where they need approvals and how it's helpful, when it's helpful to get information. This goes back to the DSAs and like how much information can they get about them and when and where so that they can move it through their own system. And so I think that's helpful there. I think Some of the other issues around transparency of debt and things like that, I think one of the hard things there is there are a lot of different creditors there, and they have different views on how they want to structure things. So that's a kind of slightly different question, especially given the counterparts in the kind of the MAF or PBOC that we're usually talking to.
Last question.
Andrea Shalal with Reuters. Thanks, Jay. Thank you, Peter. I wanted to follow up on the kind of previous question before that and then pose a different question. So on the makeup of the debt that you were talking about, you said it's more private and then emerging market creditors, i.e. China. But how much of that private is also Chinese? Can you ballpark that for us?
Yeah, so this was in the talking not just about the debt, but actually the decline in net flows. And I am fairly certain, and I am trying to look if my team is nodding at me or shaking their heads, that that when we talk China there, we are aggregating all Chinese flows. And so in part because of what we're saying about, it gets a little blurry some creditors are clearly commercial and some clearly official, but it is a little easier to just aggregate China and not have to kind of pick out the gray cases. So in that sense, when we're saying more of the decline over the last couple of years has been private, but a chunk has been China, the private is all non-China private.
And then, so that's actually a really nice segue to my second question, which is, I'm puzzled because of the resource-rich nature of a lot of these countries. Whether it's, the African countries, that so many of them are in trouble, but also, it just seems like there are great investment opportunities there. You have this sort of demographic dividend. What is your best understanding of why there's been so much of an outflow, particularly on the private sector?
I think it's a great question. In many ways, it's probably, it stretches beyond what I could do quickly, but just to say that, I think, yes, kind of the opening setup of the speech was to say, these are naturally, you would expect flows towards these countries, right? They are capital scarce relative to the rest of the world. If they have sound policy frameworks, they should have expectations of growth. I think you could say, in a crisis, people sometimes shift their risk appetite. And so between both COVID and Russia's attack and invasion of Ukraine, both may have made some private creditors decide this is not one I want to take a more forward-leaning perspective. I think in some cases it has to do with information flows and a little lack of clarity around which of these investments seem like safe ones and which don't. And I think that's where some of the credit enhancements we talked about can in some cases be relatively low-cost ways to get past some of the concerns that private creditors have. And in other cases, it's just trying to make sure that whether it's, that when the IMF is working with a country that everybody believes like, okay, this country is going to be fine. I believe the macro framework has been put in place that this is now a good investment, and so I'm going to come in more.
I think with that, I know the Undersecretary has a busy calendar for the rest of the afternoon, as we'd expect. So thank you very much, and we appreciate all the insight.
Thank you, Peter.